Well, on that note, let me bring on board our next guest for today. Joining me is Alok Agarwal, who's the head quant and portfolio manager, Alchemy Capital Management. Great to have you on the show, Alok. Let me first begin by asking you, how are you really positioned in the market right now ahead of the June 4 verdict? We have seen some bit of recovery creep in, and we've reclaimed that 22,500 mark. But would you remain on the sidelines now and wait it out for the mega event to first get out of the way and then look at nibbling in?
Yeah, hi, good morning. The past data and multiple elections in the history have shown that waiting for events have not really worked out. Simple crunching of data shows that in the last 25 years, all election results date, if I take 6 months returns prior to the election result date and 6 months returns post-election result dates, they have all been positive. So and we have learned it in the past as well, that waiting for a particular event and then taking a decision is not always a great thing to do. We do have exposure to companies and sectors which have a much better visibility of growth going forward. That's how we are positioned. So we don't really take a big call on a particular event going forward.
All right, that's the view. Of course, you can never really time the market, as experts say. But since you mentioned being invested in some pockets, I want to first ask you your thoughts on the IT pack. We've all seen the numbers, both from large cap and mid cap names, and although managements have maintained that revenue wise things may have bottomed out, but weakness is still there, until unless discretionary spending really picks up in US, Street does expect some bit of weakness to persist. So would you wait it out for another quarter before taking a call on IT, or would you say that, okay, things have bottomed out and now we could see recovery in the second half of FY25?
The way we look at IT, let me put it this way, let's look at the context. Ever since the post-global financial crisis times in 2008, from that time till about the COVID crisis in 2020, this 12-13 year period was a period where India was growing at double digit in terms of nominal GDP, but our corporate earnings growth were in single digits. These were the times when the sector like IT was growing in a decent double digit profit growth. That came at a balance sheet which was debt-free, ROEs that were decent. So that was a time that the sector did extremely well. But post-COVID, especially post-2021, the things have turned considerably. Now the earnings growth expected on the market for next 2 years, if I look at the Bloomberg consensus numbers, is close to 15 percentage points or so. Compared to that, the sector is likely to grow at 10-12% based on the consensus numbers. So that is a below market kind of an earnings growth, compared to which their valuations continue to command a premium as if they were growing at a pace which was higher than that of the market. That's why the growth versus the valuation metric doesn't work in its favor. I completely buy the point that yes, until and unless the discretionary spending in US picks up, it will be difficult for the frontline IT companies to deliver some kind of a growth that may excite the market participants. There was growth coming in the mid-small cap space in the IT segment, especially in the ER&D space. And we have seen some of those stocks doing well, and the valuations have also been on a higher side in those stocks. So those companies, as long as they can deliver on the growth, they may likely to do well. Our positioning in IT continues to be underweight, and we will wait out for the earnings growth numbers to come out and management commentaries to pick up. And more importantly, that would also be seen in terms of hiring numbers. The hiring numbers is a negative number currently. And that action and that belief of the managements that ordering as well as growth is visible, that could be seen through the hiring numbers as well.
Another pocket that I want your thoughts on is the FMCG pack. Here as well, we have, we've been talking about rural demand recovery since time immemorial, and things really haven't picked up. But this time, the managements have, given out very good outlook when it comes to the rural markets. Premiumization is already working for them, right? But here as well, would you wait for some bit of evidence that yes, rural recovery is now reflecting in the numbers? This is when I take a call, or would you say that let's go by what the management is saying, FY25 will be much better in terms of volume recovery. So anyway, valuations have come down after the kind of underperformance we've seen from the FMCG pack. So would you say that this is the right time to take a call?
The situation seems to be quite similar for the FMCG sector as well. There's no doubt that FY25 could look better than FY24, but the fact remains that last 3 years we have seen kind of a muted growth in this sector, either in the top line or in the operating profits. The majority of the sector has barely grown decently in the last 3 years. On the back of suppressed growth of 3 years, we may see a bounce in FY25, but will that be sustainable or not is something that we need to find out. Valuations, yes, they have corrected from the higher numbers, but from a 60x kind of a number, if they correct to a 45x, for which the earnings delivery is about 10-12%, that is the context that we are talking about. The things were very different when we were having the rest of the market growing at 6-7 percentage points. Now, when the rest of the market is growing at 15 percentage points or so, this 10-12% number has to actually bump up much more. There's no doubt there is a recovery in the rural side, but again, the durability of the same has to be seen. We cannot overlook the fact that the K-shaped recovery was seen globally and very much visible in India as well. That's why the discretionary pack, as you mentioned, the premiumization is working well. So the premium end is working well. The top 5-10% of the population who are in the customer segment for the companies, those kind of segments are doing well. But the bottom 90% are the ones that are kind of struggling to premiumize or struggling to grow at the pace that would be really liked by the managements.
Right. Looking at the specialty chemicals pack now, do you think this pocket is poised for recovery, especially the agrochemical side of it? Because UPL, numbers were good and management outlook was, extremely buoyant. So this particular pocket has also not been able to fire up. The China plus one, theme hasn't played out, and the risk of China dumping is still there. So what is your view on the overall chemicals, specialty chemical space and the agrochemical space in particular?
So again here, this is about a sector that has not been doing too well in the last 2 years or so. Let's look at broaden the horizon and look at last 10-12 years, then we'll understand the context. In the early decade of 2010 to 20, if you go back to say 2012-13, this sector used to command a valuation of about 10x. That used to be the valuation. But then started a phenomena where China wanted to have an impact, wanted to improve their own environment, etc., and they wanted to reduce their capacities, due to which a lot of capacities in China plus one started coming in India's favor. 2014 onwards, there was a big growth coming in the chemical space. Fast forward to 2016 end, with the change in guard in terms of US elections and the new president coming there was far more sanctions on China, and China plus one picked up even further. We had a Goldilocks situation for the sector. The earnings were growing and the valuations that used to struggle at around 10x or so started spurting to 40x. So that was a golden period. Now what has happened is that the earnings growth have started coming off, and that 40x has started coming down to say a 30x kind of a multiple. So the multiple is low from the peak, but substantially higher from what it used to be earlier. We are watching the segment very carefully. Within the chemical space, more than the specialty chemicals, as you rightly pointed out, the agrochemical space looks more poised to bounce back ahead of specialty chemicals. But we are looking out for the numbers to show that, and the leading companies in the specialty chemicals to start guiding for the better. The correction offers an opportunity. This could be great times. The risk reward keeps improving. But the way we follow is that we would want the earnings commentary to start coming off better and green shoots to be visible before we take a position.
All right, last question really, Alok, which are the themes that you would be keeping on your radar with a medium term perspective for the next 2 to 3 years now?
So what has changed drastically in India, I'll take a couple of minutes for this. We had a period after the dot-com bubble burst in the early 2000s, till from the lows of 2002 or 3 till about the global financial crisis. All capex oriented companies, all B2B businesses, infra, utilities, power, etc., they used to do pretty well. The moment the global financial crisis happened until about the COVID crisis, it was completely U-turn. All cyclical sectors started doing poorly, and consumer-facing sectors did very well. And that was a major theme that did exceedingly well. But what has happened post-COVID is due to the change after COVID, due to the K-shaped recovery, the focus of the government also on increasing the manufacturing contribution to GDP, plus sectors like defense and railways opening up. Some of these sectors have been badgered for last 15, 16 years. So we are seeing great growth numbers coming from the domestic cyclicals. When I say domestic cyclicals, I refer to industrials, defense, railways, utilities, auto, and real estate. So these segments are doing exceedingly well, not just on the price front. Their earnings growth is excellent. There are a lot of companies which were earlier in losses have started coming to profits. Those which were in profits are actually growing and surpassing expectations by quite a margin. So we do see a lot of legroom for further growth to come in. And these segments have been coming back after almost sleeping for 10, 15 years. So our exposure and positive view is more on the domestic cyclical side. And we do expect earnings growth to lead the market growth of 15%. So while some sectors were growing at around 10, 12%, overall market is at 15, and we expect domestic cyclicals to record earnings growth of more than 20 percentage points over the next 2, 3 years on an annual basis. So that's the segment that we are most positive on.
Of course, point taken, Alok. Some of these PSU names and industrials, as you mentioned, have gone from being the most neglected to emerging as the darlings of the market now. But Alok, I'm afraid that's about all the time we have in today's show. But I would like to thank you for taking out time and joining in this Saturday morning and sharing your thoughts with us. Look forward to having a longer conversation with you sometime soon.
Likewise, thank you so much.
Thank you. Thanks a lot.